Even with markets near record highs, your next guest sees opportunity everywhere, from big tech to retail, but you got to be smart about the stocks you're buying. Jason Snipe is principal at Odyssey Capital Advisors, where he manages money mostly for retail clients. Jason, it's great to have you on the program. You've got a bunch of picks for us. Before we get to individual names necessarily, I want to ask you this, followed up on that conversation we just had. One of your picks is a P&G, Procter & Gamble. Are you more willing to pay a 20 or 25 or 30 multiple for a P&G because interest rates are low? Because that's on a macro level what Goldman just argued is happening with the entire market.
Thanks for having me. So, yeah, absolutely. I think for us, the weakness in the dollar and looking at some of the multinationals and companies like P&G and Colgate, where there's just a lot of demand for consumer products, and particularly at P&G is a name that we recently added with doing over 50% of their business overseas. We just see it as a long-term opportunity in a place that there will be some growth, because we do think the dollar will remain weak for some time.
And you must, as part of your thesis on a P&G, maybe even a Costco, another name you like, is that weaker dollar that Karen talked about as well? Is that part of your macro thesis?
Absolutely. I think that's really the driver and catalyst behind, adding some of these multinational names over the last couple of weeks, and kind of what the Fed has been doing over the last several months. So we see opportunity there. We see demand for those products, the grocers, and obviously the consumer demand for obviously the cleaning products that P&G sells. So I think there is an opportunity, and that's a large part of our thesis.
We've got more on the home builders coming up, so I don't want to steal too much from that, Jason, but D.R. Horton is one of your picks. We just showed it up 55%. I mean, the home builders are just on fire, even as the price of lumber is at record highs. In other words, their input costs, we talked about inflation, are going up. At some point, do you start to trim the D.R. Hortons of the home builders, or are you confident this run can continue?
This is a great question. I think that the home builder numbers, I looked this morning and saw how what the home builder sentiment looked like, which is tremendous. D.R. Horton, as we look at this migration, the slow migration from some of the urban centers to the suburban, cities across the country, we see opportunity there. I think they will continue to grow. Now, I think they might slow down heading into the winter months as the purchasing season starts to slow, but I do think there's opportunity there for the long term, particularly as well in a low interest environment.
D.R. Horton, Costco, P&G, Jason Snipe, Odyssey Capital Advisors. Jason, great to have you on Fast Money. We'll see you again soon, I hope. Take care.
Thank you.
All right, let's trade this. Tim Seymour first. Go to you. What do you make of Jason's picks? Anyone stick out more than any others?
Well, I think we're gonna talk about retail in a bit. I do think that the retail sector is a place where a lot of people have underestimated both the earnings power, especially for the haves in the post-COVID-19 world. But if you look at the XRT, believe it or not, on a one-year basis, not just through the crisis, it's outperformed the S&P by almost 16%. I mean, that's something people don't understand. So I do think you're going to continue to see some of those plays in the retail sector, which are advantaged by both the stay-at-home, the home upgrades. I mean, the home builders market, we talk about these secular trends all the time. We talk about low interest rates. We talk about the millennials are actually buying that fixer-upper. There was a special on CNBC about that today. Those themes are very much intact, and they play into all the companies that are certainly surrounding the home improvement trade.
Karen?
Yeah, I agree with that one, actually. And I mean, good for Jason for owning P&G. I wouldn't have owned it for I don't know how many points. But, it continues to be a beneficiary of all the things you said, the weak dollar, and, the consumer wants their products. So good for him for owning that. I like the home builder space and related a lot. I think a lot of the macro is setting up well, and it was undersupplied coming into the pandemic. And you had so many factors, a rush to the suburbs, and very, very low interest rates. Probably the labor shortage that housing was facing is probably better now as well. So a lot of things to like. Not that they haven't moved, they have, but I still like a lot of the space.
Yeah, and Procter & Gamble, Brian, excuse my phone going off. It's, I understand if people love Procter & Gamble, but understand that Procter & Gamble is expensive given its history, and it's expensive to the market. Valuations at some point do matter, and you really don't have the earnings growth to back it up. So, although people are piling into P&G and that stock continues to go higher and make new all-time highs, understand that this is not cheap by any measure whatsoever. And at a certain point, valuations are going to matter, not only for Procter & Gamble, but for the broader market as well.
Yeah, Dan, quickly on that, I mean, you heard Jason talk about the weaker dollar theme. If rates keep going down, to your previous point, the dollar keeps going down, do we give a you-know-what about valuations? Can you own a P&G? They make Swiffer at 30 times earnings.
Yeah. Well, listen, we were already ready to pay 22, 23 times for some of these staples, some of these dominant retailers like a Walmart, something like that. I mean, so I look at a consumer staple like Coca-Cola, which has been really much hit harder than some of its other staple peers. This stock, to me, has been a massive laggard. I think you get this thing above 50 over the next few months, especially if the dollar keeps going down, interest rates stay really low. This could be a decent catch-up trade, 3.5% dividend yield. And we know that this is a very unique hit, the lockdown situation to Coke. And at some point, if they're going to discount valuations on every other company that has been hit by this or ones that are actually winning the pandemic, at some point, I would expect to see money flow into a name like Coca-Cola.